All right, let's jump right in. Today, we're going to tackle a really fascinating question. How do you figure out what a silver company is worth before it's even dug a single ounce of silver out of the ground? We're going to use Vizla Silver as our case study to really understand the price of pure potential.
So here's the central puzzle, right? How do you value a treasure that's still buried deep underground? And this isn't some philosophical riddle. It is the absolute core challenge when you're looking at a company like Vizla Silver. It forces you to think completely differently, beyond today's profits and way into the future.
Okay, first up, the silver blueprint. Before we can even start talking about dollars and cents, we have to get a handle on what kind of company this is, because spoiler alert, it is not your typical miner.
Vizla Silver is what's known in the industry as a mine developer. Now, this doesn't just mean they have a hunch or a good idea. No. A developer has an incredibly detailed engineering plan. It's called a feasibility study, and it lays out everything: how they're going to build the mine, what it's going to cost, how profitable it could be. But, and this is the most important part, they are not making any money yet. Zero revenue is coming in the door.
And this slide really nails the difference. A producer, think of a big established mining company, is valued based on the cash it's making right now. Their risks are things like equipment breaking down, operational risk. A developer, like Vizla, a completely different beast. Its value is based 100% on cash flows that might happen in the future. And its biggest monster to slay is build risk, the massive challenge of actually building the mine on schedule and on budget. So if it's all about future potential, how on earth do you actually calculate that value? Well, that brings us to our next section, and what I like to call the magic multiplier. This is the real key to unlocking how Vizla is valued. The secret weapon for any mine, the thing that unlocks massive profits, is keeping your costs low. And the number that everyone in this business obsesses over is the all-in sustaining cost, or just AISC. It's basically the all-in price tag for pulling 1 ounce of silver out of the earth. And Vizla's number, straight from their big engineering study, is just $10.61 per ounce. Now, for anyone who follows the mining world, you know that is shockingly low. And to really put that in perspective, just look at this comparison. Vizla's projecting costs around $10.50. The average company that's already producing silver, they're spending somewhere between $15 and $17 an ounce. This huge cost advantage is the engine that drives all of Vizla's potential. And because those costs are pretty much fixed, it creates this incredibly powerful financial lever. For every single dollar the price of silver goes up in the market, Vizla's potential future profit goes up by a very specific, predictable amount. It's almost like clockwork. And here it is, 25 cents. For every $1 move up in the price of silver, the company's projected net asset value is expected to increase by 25 cents per share. That's the magic number. Remember it. All right, now for the fun part. Let's take this multiplier and play a little game of what if. We're going to explore 4 totally different futures for the price of silver just to see how this incredible leverage could actually play out. So we'll kick things off with scenario 1, which is the super conservative case. This is the analyst consensus, basically the long-term silver price that Wall Street analysts often plug into their spreadsheets. A nice round $30 an ounce. At $30 silver, the operating margin, that's the profit on each ounce, would be a very respectable $19.39. This all translates to a baseline net asset value of about $3.57 per share. Think of that as our conservative starting point. Okay, but what if we use the spot price from when this analysis was first done? Scenario 2 assumes a much higher $82 per ounce. And this is where the economics really start to get exciting. I mean, just look at that jump. The operating margin absolutely explodes to over $71 an ounce. This is where having that super low-cost base really shines. And that, of course, translates into a massive increase in the company's underlying value. The net asset value per share skyrockets to $16.57. That is the power of that 25-cent multiplier doing some serious work. But let's not stop there. Let's keep going. Scenario 3 is our bullish case, where silver really takes off and hits $120 an ounce. At this price, the economics just become extraordinary. The potential profit for every single ounce would be nearly $110. And the project's intrinsic value just keeps climbing.
The NAV per share would now be sitting at over $26. And finally, just to see the absolute maximum leverage in this thing, let's look at a super bullish case. What if silver were to do something crazy and hit $200 an ounce? The profitability becomes almost hard to wrap your head around. The operating margin would be nearly $190 for every single ounce they produce. And this pushes the potential net asset value, just based on their initial plan, to over $46 a share. Truly staggering. Okay, let's just pause and put it all together on one table. This makes the whole story crystal clear. As you just trace your finger down the rows, you can see how every jump in the silver price dramatically multiplies the potential profit and, of course, that estimated NAV per share. The leverage is just undeniable. Now, after seeing all of that incredible potential, it is absolutely time for a reality check. Because those numbers, as compelling as they are still just projections on a spreadsheet. And here it is, here's the catch. Remember that phrase from the beginning? Build risk? All of that amazing potential value is only unlocked if Vizla can actually build this mine and do it on time and on budget. That is a huge if. You know, there's another piece to this puzzle. Sometimes you'll see analyst price targets that are even higher than the NAVs we calculated. So why is that? Well, it's because they're adding what's called exploration credit. They're basically making a bet that Vizla will find a lot more silver and that this mine will be running for way longer than its initial 9.4-year plan. So, after all that, what does this really boil down to? Well, it's the classic story in investing, isn't it? It's a fundamental trade-off between risk and reward. So here it is, the core trade-off, laid out plain and simple. The pros are obvious. You've got this incredible leverage to the price of silver, all powered by those world-class low costs. But the cons are just as real. The company has to execute the build perfectly, and you're buying a future promise, not a current cash-flowing reality. Which leaves us with the final and most critical question. For any investor looking at this, does that immense quantifiable leverage to the price of silver outweigh the equally real risk of building an entire mine from scratch? That, right there, is the multi-billion-dollar question at the very heart of the Vizla silver story.